You're in the Business Insurance Zone with me, Steve Savant, national insurance columnist and financial color commentator. This week on The Biz, our Index Universal Life Insurance Product Exposé featuring Athena Index Universal Life Insurance with Matt Berman, Vice President, Sales and National Accounts with AXA Distributors.
When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.
Well, welcome everyone to the Business Insurance Zone. I'm Steve Savant, your host, and we're broadcasting live to a nationwide audience of financial advisors right here in Fountain Hills, Arizona, home of America's largest fountain. And with me today, day 4,
is it already
Matt
Thursday?
Berman. Yeah, it's
Good
Thursday already. Wow, it just time flies when Matt and I, we don't change clothes. What can I say? You know, it's just the way it is. Today we're talking about ultimate controversy, and I know that when people say this, and especially when they Google the front end of this show, they're going to say, Steve and controversy, here we go, because I would never tell you if it wasn't controversial. I wouldn't bring it to you. We're talking about policy loans. Now, everybody loves policy loans because if I keep the contract in force for the life of the client, and I am TAMRA compliant at issue, I'm going to have some nice tax-free income. But all loans have costs.
Sure.
Can't escape it. We're going to talk a little bit about a complete renegade move, in my view, by AXA. When the world goes this way, AXA decides to do something counterintuitive. It is kind of it's refreshing to see a carrier take a whole stand on this, and we're not saying one way or the other. This is not what our show's about. We're not here to tell you which way to go. We're just wanting to make sure that you see the full Monty of what we're talking about. Am I using Index Universal Life with participating loans, or am I using Index Universal Life, in AXA's case, without it? Now, you guys made a big determination against the move of the market back in the spring before you launched out the refresh in July. Sure. So let's talk about that, because I'm curious why you went down this road. And by the way, I will give this away. I got a monster paper here from AXA written here. This is a great piece on policy loans, and if you want the fear of God, order this at The Biz at brokersalliance.com. This will kind of give you the yin and yang.
Yeah, so well, thanks, Steve. I think that, we recognize, as we have with a lot of products and offerings in the marketplace, that there is a time and a need for a lot of different offerings. I almost think that the variable loan conversation is similar to the conversation that we had some time ago around secondary guarantees. We recognize there's a time and a place and there is a need for that offering. But based upon how we have chosen to execute risk management, our product philosophy strategy, we've decided to go a certain way. And at times we've been the outlier in the pack, but I think for the direction of our business, the promise and the longevity that we are making to our policyholders and to our shareholders, it's been a direction that has served us well. So when we talk about loans specifically, I think it's simply put that we view Index Universal Life primarily as a risk mitigation vehicle. And the variable loan concept is a device, or it's a feature in the policy that is really designed to give more pickup and accumulation and really utilizes leverage. And with that leverage does come some downside risk.
Well, let's talk about the two. You just made an allusion to two components. Variable contracts. I got to tell you right now, just strictly from a consumer, and remember we have a decent consumer audience watching our show. Sure. I don't like variable loans without caps. Let me just say that right off the head. I cannot have unlimited variable, loan charges. I just can't live with it. Number two, the bigger issue is what kind of leverage. The moment I use leverage, you can always bet behind that phrase is going to be an amount of risk.
Sure.
And remember, we go back to our show a couple days ago. We said risk management is an issue. It's a risk tolerance, client suitability. I want to make sure they know what they're getting when we're talking about this. So you're bringing up a huge point. I mean, when I think about having no arbitrage loans or participating loans on an Index Universal Life contract, we're really reducing some of the risk. Now, some people will protest and say, but I could have made money on my own policy loans.
Sure.
But you also could have suffered some losses. I'll get into that in the second segment.
Yep.
Talk a little bit about this because, and by the way, again, this piece that they put out on policy loans, I think is really a good piece. If you say, Steve, I want that piece, I'll send it to you. Just write me, thebiz at brokersalliance.com, and I'll send it out.
Yeah, I think that there are there are a lot of ways where the Index Universal Life contract, through an illustration, can paint a very, very optimistic picture on the future. But I think we all recognize that, one, the past is not a predictor of what's going to happen going forward. And using aggressive illustration rates and taking some leverage in terms of index crediting and the loan interest rate can really give you some really strong performance on an illustration. But when you start to back test and stress test that against certain durations historically, you get a little bit of a different picture. So again, we recognize there's a need and there is great optionality in having a indexed or variable loan in the product. But again, starting from the base perspective that we feel the policy is designed as a risk mitigation tool, we've chosen to not build this feature into our product. And I think it's fair to say that when consumers, prospective policyholders, and producers are looking at index loans, recognize that they rest on a number of assumptions. How the market's going to perform, how the insurance company is going to set caps going forward, performance in the product. If these assumptions do not come to bear during the life of the illustration, you could have some changed outlooks, and I think it's important to recognize that.
Well, let's just say I think you're being kind. When we come back after the break, I'm going to tell you about some of the things that have already happened as we snap a timeline back to 2001 and look at what I call the lost decade and how does participating loans actually work in a down market. When we come back from the break, we're going to continue to address the Athena Index Universal Life product and its application in your practice. And don't forget, you can enroll at IULUniversity.com for the best training, education, and sales support when it comes to life insurance for retirement income.
You're listening to the insurance industry's #1 resource for products, planning ideas, carrier information, and interviews you can use. When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.
Welcome to the Brokers Alliance Auction House. I'm Jessica Lopez, and that's Steve Savant. What are you doing?
I'm practicing my auctioneer skills for our carrier bidding process for our producers' substandard cases.
Steve means that we're packaging our substandard cases for underwriters with specific carriers that are known to specialize in certain health impairments.
There are really only a handful of competitive carriers in each category, and we've identified who they are.
It's all about securing the best possible underwriting offer by packaging your substandard case with the right carriers.
So let the bidding begin. Well, welcome back to the Business Insurance Zone. I'm Steve Savant with Matt Berman. And remember, you can order today's giveaways at thebiz@brokersalliance.com. And what are we giving away today? Well, we're giving away the dollar cost averaging doc. It's a huge attachment. I'd love to send it to you. Remember, a lot of our clients don't have annual monies to throw on or single deposits, but they do have cash flow in their budgeting, and I want to send that to you absolutely free. And remember, a couple days back, we talked about product suitability. I have a really great piece by AXA on product suitability. I want to send that out to you as well. And don't forget, uncovering and evaluating the needs of a client. It's huge. I got a doc for that. It walks you through a gauntlet of questions and measures the propensity for is this a risk or not a risk. Just order it at thebiz@brokersalliance.com and I'll send it to you absolutely free. And remember, just before you go through any of the ideas and go forward with anything we talk about on the show, always consult your tax advisor and broker-dealer compliance officer. In this segment, we're addressing, again, the Athena Index Universal Life product and its application in your practice. And Matt, we're talking about kind of a controversial move when you refreshed your product. Hey, you said, no, we're not going to do participating loans when the whole market was going the other way. Now, there are a few other carriers that have joined you in this crusade. And again, it's not a yes or a no, but in this document, I've looked at this and think about what I'm about to say, because this is the inventory of all the options you have on this contract. Not your contract specific, but in the universe.
Sure.
We have zero net cost loans, we have wash loans, we have spread loans, we have direct recognition loans, and now we've added to the plate this new thing called participating loans. Some of these loans are set on fixed chassis, some of these loans are set on variable chassis. Some of the illustrations that you see only show current company practice. They don't always show the guarantees. So when I'm looking at the provisions, especially when you're talking about tax-free income, this matters. Now, let me set it up and then I'll turn it over to Matt. In the last decade, think about this. In 2001, 2, and 3, we had losses, and as well as 2008. If I was taking distributions using arbitrage loans on an IUL contract, I would have been paying at the best a fixed rate of around 5%. That was my best scenario. Now all of a sudden not only did I not make any money in those years, right? But now it costs me a nickel to take my own cash out of my own contract.
Correct.
In a bad year. And by the way, that compounding effect over those 3 distribution years were killers. And if you see in-force ledgers back in 2001 for distribution all the way up, the losses were huge because I had 3 straight years. And then if that wasn't enough, 2008 was kind of like the coup de grace. We got slammed, and those distribution years were way down. So I just want to, it's not that I'm against it. I'm just saying, look, you better understand what you're getting yourself into.
Yeah.
So with that, how'd you like that introduction? Let's talk about that area because I think people don't get this.
Yeah, I think it's great that you mention it because I think that the concept always rests upon your expectation of the future. If you're an optimist, that's terrific. The policy could really perform, and the variable loan can give you some strong pickup against other alternatives in the market. But I do think it rests on your ability to set correct expectations, whether you're the producer, you're the consumer looking at these products. And what I've always stated in speaking events to customers, in talking not only about our product, but just the market in general, you really need to stress test the products you're looking at because the arbitrage or the pickup that you get is really set by the crediting rate that you're going to receive and that net benefit you get looking at the loan structure, right? So tie it back to just the illustrated rate in general when you're looking at this policy, absent of the loan. Stress test the product and start to look at the illustrated rate under various scenarios. Listen, you can hide a lot in a product looking at aggressive assumptions, but be honest, be intellectually honest with yourself about what the future may bear and start to look at sensitivities. That will give you some good guideposts into measuring expectations. So if you have a moderately bullish perspective on the market, how is the policy going to perform in those scenarios? Stress test it to how the market's performed in the past years. I mean, listen, we don't know what the future is going to hold. We just know there's going to be uncertainty, right? So I think that it's good just to understand all the criteria, all of the elements of the contract, and where you could actually see some strong performance, and where the policy has its shortcomings. So.
When I think about this, we just came back from the East Coast where we spoke at a CPA regional meeting. Interesting, we're introducing these kind of products to the CPA community, and most of the fiduciary market doesn't know anything about what we're doing. So it was really a good first entree into our world. But interesting enough, I gave the basic tale of 2 cities, participating and non-participating, and I saw the judgment by so many of these CPAs. They were starting to say, you know, I'm just not comfortable with that kind of leverage. Now again, we're not negative on it. I'm just saying fiduciary market tends to be much more conservative. If you're going to show retirement alternatives like this, so one of the things that they're going to ask you about is what type of loan. We're teaching them how to do this. We've been teaching in the CPA community for quite a long time. So they understand that. And so when we introduced it, it was all news to them. I noticed a major move to the conservative side. They thought this other side, arbitrage or participating loans, was just a little bit too, in their mind, almost like a margin call, which I thought was a little extreme, but okay, that was their thought. We'll talk a little bit about it, but we're going to be giving away this at the end of the, you say, I need data on this. We're going to give it away. Why don't you close this up and just give us one more shot at why I'm using AXA on this accumulation and now this loan feature?
Yeah, I think that as, again, philosophically, we've always felt that our position with Index UL really leverages the power of zero, having downside protection and the ability to get good pickup when the market performs. So at the end of the day, we really see our position and our value providing strong net cost, low net cost performance, and good, honest, transparent, simple chassis. So, thank you.
No. And remember, you can watch this show and all our shows by clicking the red on-demand video button right on our homepage at brokersalliance.com. Well, that's the Buzz on the Biz for today. You've been in the zone, the business insurance zone.
The Biz is brought to you by Brokers Alliance, a national leader in insurance products, support services, and educational workshops. When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.